10-year Treasury yields bumping back up higher, getting very close to that 2% level it was at just recently. Recall yesterday, though, on the opening overnight, we traded Treasury yields all the way down to 184 and have since bounced back. So it's about a 16 basis point move over the span of about 2 days. So a significant move off those lows. Today we saw yields move up about 5 basis points. So a lot of that move we saw yesterday. However, significant enough that there was a risk-off trade, flight to quality bid to Treasuries that has reversed itself. We now see Treasuries back nearing 2%. And at this point, Treasury yields, which put their low yield print of the year in on the first trading day of the year, on January 3rd, have seen nothing but higher yields most of the year. A lot of that based on what the Federal Reserve is anticipated to do, that is raise rates. They've already started tapering their asset purchases. So in this case, a lot of this expectations that we're seeing is based on the higher inflation we're seeing and what the Federal Reserve is going to do in the months ahead, which is raise rates and not have such an accommodative policy. At this point, 2% seems to be a home. We have some significant events coming up, not this week, but next week, and we'll talk about that in a moment as to why we may see a stall in the rise in yields that we've seen. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you will notice that volatility remains directional with yields. As we see yields moving higher, especially when we see them moving higher faster, we see volatility moving higher as well. So volatility, while it was only up slightly today, continues to trend higher as yields move higher as well. And lastly, what do we have the rest of the week? Well, tomorrow we get the claims number, which is our in-the-moment look at the jobs. Certainly expecting that number to be right around 235,000 new filings. That's a bit elevated to where we would want that given the recovery in the economy that we've seen over the last several months. But again, it remains elevated, especially a surprise after last month's strong jobs number. We also get a revision to GDP, which isn't expected to be much. GDP came in around 7% for the fourth quarter. That's likely to remain the same. The big news that we're going to be seeing is not this week, but next week. We get Mr. Powell speaking to Congress. He gives his semi-annual testimony. This comes just days prior to the February jobs number and about a week prior to the FOMC meeting, which will be the beginning, or is anticipated the beginning, of a rate hike cycle, which could start with as much as high as 50 basis points. Right now, the market pricing in definitely 25 basis points for the March FOMC, with about 40% odds of them going 50. But again, it all contingent on what we see and what we hear from the Fed over the next week or so. And Mr. Powell speaking to Congress, likely to give his picture and give his ideas of where he sees rates over the coming year, and that will be very important. The market will continue to watch that. So 10-year Treasury yields back to 2% after yesterday touching 184 ahead of tomorrow's claims number, but people really looking forward to next week when Mr. Powell will speak directly to the House and the Senate on his semi-annual testimony.